All right, ladies and gentlemen, welcome back to our weekly State of the Market with Finom Group. I am your host, Seth Golden, and is this our third time, Brad? I'm
Yes,
joined by Brad
you're a
Carter.
third one.
Third time he's helping. He's co-hosting with me. Apparently, I didn't scare him off. So, Happy New Year, Brad, if I haven't
Happy
already.
New Year.
And so far, pretty happy new year for the markets as far as the first couple of weeks of trading is going, right?
Yeah, pretty good.
It is just 2 weeks.
I often forget to kind of reset either at the end of December or at the first of January. And you can get kind of caught doing that. But this year, if you didn't, you were okay.
Yeah. Um, I was looking at so many different metrics because just thinking macro fundamentals, thinking about the economy coming into this year. And I think we all have heard by now, what is it, Harvey Campbell, who did his dissertation for his PhD on the yield curve,
Right.
to find that, his studies found that 8 out of 8 of the previous recessions were signaled by, the inversion of the yield curve, or the threes and tens, most specifically the 3-month and the 10-year. But he's been out earlier this week on CNBC, and Bloomberg did an opinion piece where they interviewed him, and he basically said, the signals 8 for the last 8 recessions. This yield curve inversion, came before it, basically signaling that a recession was ahead. But he doesn't feel that this time,
Right,
it will produce the same signal. And he gave 3 different reasons why he doesn't believe so. But as you can see here, our lead into the state of the market starts with the 4 most expensive words in the English language are "this time is different," from the famous Sir John Templeton. So
yeah.
we don't know if this time is going to be different, but I can tell you that there's a demand for context when we see this colloquialism thrown about, this phrase from John Templeton thrown about, because the reality is every cycle is different. They may have similar characteristics and nuances, but the circumstances tend to be different every single cycle. Am I right?
Yeah, and I've been thinking the last couple of days about this and some comments you've made over the past year. If you think about it, since last January, I mean, nothing is lined up like we've thought it was going to.
Right.
It's just it's just been crazy. I wouldn't be surprised if there's no recession, and I wouldn't be surprised if there is one. And I'm a little concerned that the Fed might actually overdo it a little. And that could cause what I think would probably be a relatively short-lived, shallow recession. But I don't think it's necessary, and I hope they get that.
I totally agree with you. I think this last hike that'll take place at the February 1st meeting, which is just around the corner, I think they would be well advised to leave it there. 25 basis points, which we've heard from 2 Fed presidents in just the last 2 days, saying that they would actually be in favor of 25 basis points. And with today's CPI reading, I think it gives them well enough cover to move from 50 basis points down to 25 basis points. And then pause, look around, see, the bond market is screaming pause. The bond market, we've got the 10-year yield down to 3.5%, and we've got the 2-year yield under the Fed fund rate. The 2-year yield.
And really, Seth, if it looks kind of like it's looking now, the trends, next month when would be the time they would raise again. I don't think it would hurt a thing for them to just to pause now for 30 days.
Agree.
Yeah.
I've been arguing that the December hike should be the last one.
Yeah.
I just think, that they want to have this scale. They scaled up, they want to scale down. And look, they're still kind of scared about the wage inflation. So okay, we give them the last 25 basis points, and they'll take it. Whatever the market's giving them, they will take. And right now,
Yeah.
the market is giving them a runway to do the 25 basis points. The market is actually pricing in another 25 in March, but that can change really quickly
Yeah.
after this February meeting. More than likely, what we see now by being priced in as another 25 basis point hike in March will probably start to level out to 50-50 odds because the data just doesn't warrant any more hikes. We're now 6 months into a disinflation cycle, and that is before the services inflation within the CPI actually shows the shelter and rent components. Like that still hasn't hit. In fact, the CPI report, I think the shelter component was up 0.8%. I mean, when the shelter component finally hits, it's going to hit like a ton. It's going to be like an anvil, a sledgehammer on CPI. And it's not like the Fed doesn't know this, but you know, with all the conjecture, with all the constant rhetoric in the financial media and the will they, won't they that is allowed and pervasive, you know, amongst participants, it almost becomes, well, not almost, it becomes self-fulfilling. If you're going to give it to them, the Fed's going to take it all day long. They'll take.
Yeah, I think so.
So that's how I feel about it. You know, coming into this year, I hope everybody, you know, is you know, in a good position where they can take advantage of any value that might be found in the markets with, you know, some level of volatility through the first quarter. But as it was towards the end of the year last year, as a reminder, I say, keep it simple, stunad, which is an Italian phrasing. Keep it simple, stunad for 2023, or KISS. Everybody knows the acronym KISS. So what I say here is market will be well beyond your comfort buy level by the time your defined signals are confirmed. Everybody has these different signals that they rely on. And one of the things that I often, you know, find funny about these so-called signals, it is why you are constantly redefining your confirming signals, right? Everybody's always playing with their signals. And it just gets so complicated. And by the time you figure it out, the market is well beyond your quote unquote buy signals. And you don't want to buy when it's well beyond that level. You know, just keep it simple in 2023. Have a practical game plan of where you're going to allocate capital. Let the headlines, you know, flow as they're going to anything. There's nothing you can do about the headlines. There's nothing you can do about volatility. The only thing you control is your game plan and your discipline in 2020.
Right. You know, and if you do like I did, maybe, well, I kind of got forced into doing what I did for tax reasons, but I took a lot off the table at the end of December. If you've done that and you've approached January very, very conservative, like I did, more conservative than I wanted to, there's no harm in stepping in and chasing just a little bit on the stuff you know that you feel in your gut is good. I did that with TECL, for example. I jumped into that, and I think I made a comment the other day that I was chasing just a little bit. But
well, there's always, that's why I say, just like this needs context. The colloquialism, you never chase a stock, never chase the market. No, these are colloquialisms that lack practicality. If we're looking for buy confirmation, right? If we look at technicals and it hits a certain level and breaks out, that's a good thing. That's something that actually you should be chasing, because the technicals are confirming this stock or this market or this ETF is in an uptrend.
Yeah, my history on handling stuff like this is to go ahead and, here it is, January. It's signaling it might get away from you a little bit. Go ahead and chase a little, then wait for a red position. Day.
Yeah,
and when you get a good red day, then you can
put
buy
the
a little
full
more
position on. Yeah. There's nothing wrong with. I always say, if you're going to chase with less, because then you're leaving yourself, you know, downside risk management where you can add the fullest of the position that you wanted. But at least if it doesn't check back, you got something participating in the upside there. And part of the whole keeping it simple for the year, folks, everybody wants to be the best stock picker in the world, but the reality is, most stocks will underperform the market. I've long since said, being an index ETF investor is boring, but it's beneficial because most stocks will underperform the S&P 500. This is the percentage of stocks that underperform the S&P 500, and these are your outperformers. And you can see the candles are very small here for the outperforming stocks. The candles are very big here for the stocks that underperform the S&P 500. This chart goes from 2000 to 2020. According to the S&P Dow Jones indices, only 22% of the stocks in the S&P 500 outperformed the S&P 500 itself from 2000 to 2020. This, if you add up all the candles, is only 22% of stocks. The other, what's that going to be? 78% of stocks are underperforming. So, like I said, everybody wants to show off. Everybody wants to be a great stock picker, but there's very little chance of outperformance if that's all you're doing. Now, don't get me wrong. I believe, see, it's a catch-22. If you are going to outperform the market, well, you can't just be an index ETF investor. You got to own certain stocks that have a track record of beating the market or have a setup, a certain valuation, that is just looking unreasonable. Take, for example, Meta, right? Meta Platforms, the old Facebook, if you will, it dropped below $90 a share. Where is it today? $130 a share, right? And I was saying, look, this thing gets under $100 a share, it's good value. Headlines be darned. It went from, I think, a low of $86 up to $133, maybe it's $134 today, all in 2 weeks, 3 weeks. So there are opportunities like that.
My instinct was to just not touch that thing. It looked like a falling knife, but when it got that low, I picked up just a little bit, and I haven't had a chance to add because it just rocketed up.
Yeah, that's why, like, you've heard the term, generational buying opportunities. I think we've all heard that. What was the core Facebook business? I looked at it and I said, is the core Facebook business going away? The answer is no. It's suffering just like, every other company in the advertising space. We've seen the same thing from Google. A portion of the Amazon business is now advertising. We saw the same thing from Snap. So the biggest, problem has been advertising spending, ad displays on the platform. And the second problem is just the spending, the capital spending on the metaverse. But, that core business is not going anywhere. And the cost side of the equation that fuels earnings could always be pulled back. So below $100, I said, what's the worst I can do here? $75 a share? All right, I'll throw some money at it. And the thing just rocketed higher. I think I did sell, everything yesterday at $133, from a cost average of about $105.
Yeah.
So, and again, that's in a matter of a couple weeks. There's not a lot of those opportunities out there. And at the core of my portfolio is index ETFs.
Mm-hmm. So. Something really interesting that happened last year. We talked about this a little bit, I think, the last time we got together. But I looked at the numbers this morning, and the S&P was off how much for the year?
For last year, 19.6%, 19.6.
Okay. My biggest winner by far was short UVXY.
Yeah.
The S&P.
Who would have guessed, right?
Yeah, Seth, I think you and I have been doing this short volatility for long enough that you get to where you can just feel it.
Yeah.
And without even, there are days that go by that I don't even look at the VIX index and stuff like that. I just know. And so I I short and cover based on gut feeling of what the market's about right now, and it just never really panicked.
Yeah, I mean, these are our trades in our spreadsheet from all of last year. We had
Wow.
300 trade alerts, of which 93% hit rate. And you can see all the UVXYs, all the VXX short volatility trades. A lot of you can see now all the PayPal trades. As of today, now we have 61 completed PayPal trades that we've done since last year. We completed one here today as well. That's one that I like long term. So building a core position. We started at about $100, but we've done 1% scalp trades to build the core holding 60 times. So 100, and that 1% is $1 each time, just about. Our cost basis now is around $45 a share, and the stock is just around $80 a share right now. So that's how I build up most of my core holdings, is scalping. We've done scalps because we're building core holdings in the healthcare sector ETF as well. I think we've done it, about 5 of those in the healthcare sector ETF, ticker symbol XLV, and I'm building long-term position in Visa as well as Amazon going forward. I think Amazon is kind of like Meta. It may even gear up for a Meta type move, pending reasonable outlook when it delivers its fourth quarter results later this month. I think that's geared up for a pretty strong move to the upside. Having said that, definitely looking at this possibly also being the last bad quarter for the company, simply because it wraps up the year. And but we'll see. We'll see what happens there. Either way, downside to me is one. Again, I'll just be buying more. The core business of Amazon, has suffered through an economic slowdown, as well as just the diversion of spending. There was a lot more brick and mortar spending last year than the year prior, because people felt I shouldn't say completely, but more comfortable going out and spending, and they wanted to be out of the house, this last year, because it really was the first full year that people could go out and spend. So that diverted some of the usual online and e-commerce spending back to brick and mortar. But what I saw in the fourth quarter was a reversion again from brick and mortar back to e-commerce. Bed Bath & Beyond, right? I've been saying this is on my bankruptcy chain when it comes to the department stores: Dillard's, Kohl's, Bed Bath & Beyond, Macy's. All of these are on the bankruptcy chain that I developed back in 2016. And, my call was that by early 2024, more than likely, Bed Bath & Beyond would lose its credit revolver and it would have to file for bankruptcy protection. What we're seeing from, that company now, obviously, is it might be expedited. So it may come in, the back half of this year.
Yeah, I've got Big Five on my short list.
Yeah, yeah. Here's
I think I'm short that right now a little bit.
Yeah, we haven't talked about this study from CNBC for a while. This is the Market in Turmoil study from Charlie Bilello, and he's tracked since 2010 the first airing of a Markets in Turmoil. And from that point, a year later, 1 year forward returns, as you can see, have always been positive. Always been positive. The first Markets Internal for 2022 came on May 5th. May 5th, 2022. Now, the S&P 500 was 4147. So if this is going to maintain its 100%, positivity rate, the S&P 500 is going to have to be above 4147 on May 5th of this year. again, it's very compelling, right? It's
Yeah.
very compelling. So we'll see what happens. But I always thought that was an interesting one. Of all the studies that, they say when there's blood in the streets and when there's a market in turmoil episode, it seems like there is blood in the streets and it's the time to buy. Some technicals here this week that I really am finding favor with. I mean, the technicals have really breadth. All we've heard is that just because the calendar changes doesn't mean the market changes. Well, tell that to the January effect, right? I mean, it's called the January effect for a reason. And what we have seen underneath the hood of the indices is a real at least the green shoots of a character change. This is the percent of NASDAQ stocks above the 200-day moving average, folks. NASDAQ stocks, not S&P 500, not the NYSE, but pretty much the worst performing index of all the large cap indexes last year. And now, as of yesterday's close, it has 37% of stocks within the NASDAQ above their long-term moving average. We haven't seen that kind of a number, this many stocks above their 200-day moving average, since November of 2021. And you can see the surge. We can see the surge. I mean, this looks good. Now, the only caveat here so far as, well, what does that mean for the index going forward? It is just 37%. It's not the majority of stocks. But we have to start somewhere, right? And this is a really good way to start the year for the NASDAQ with this kind of surge in stocks trading above their 200-day moving average. So wanted to point that out. And this is another one. Again, talking about character change in the market, breadth. What's going on? Do we have strong breadth or do we have weak breadth? This is the total stocks in the US. And this is the net new highs. So we're taking, the net new highs, new 52-week highs, stocks that are making 52-week highs, and we're subtracting the stocks that are making 52-week lows, and we get our net new high percentage of all stocks in the US. And as you can see, like we hit this resistance line several times last year and couldn't get above it until yesterday. We broke.
Yeah, and look at how those were every time we got thrown back. That was nothing but the Fed taking us to the woodshed.
Right. Almost every single time. Yep. Yep. It was rate hikes or it was rhetoric. It was this Fed speaker or that Fed speaker. Yeah. Time after time.
I think it was more the rhetoric and the tone than it was the hikes.
Yeah. Yeah. I'd agree because, since the first 75 basis point hike, the S&P 500 is actually higher than where it was that day. Remember, the first 75 basis point hike was June 15th. The market finished that day at 37.89. And we've had 3 more 75 basis point hikes since in the 50 basis point. And the market is higher today than when it was on. So I agree with you. I mean, that's just the facts. It's not so much the rate hikes. It's the fear of the rate hikes that is just beaten into the heads of investors by all of these Fed speaking engagements throughout the months. So character change here, folks, afoot, whether it's the US new highs minus new lows, the NASDAQ is showing signs of a character change. Mark Ungwitter chimed in on this because, historically, this is a very positive development. The one time it wasn't, higher net new highs in mid-2001 and early 2002 didn't end the 2000 to 2002 bear market. So it's worth noting that, usually nothing's perfect. But I also want to show that, hey, look, we're taking, everything into consideration here. The good and the bad. This is one that is dangerous to me, right? This is the technology sector ETF versus the S&P 500 itself. And as we can see, over the last, we'll call it a year and a half, we've come down in this performance ratio, technology versus the S&P 500. We've tested this support 3 times, and we've tested it just recently here in the new year. Now, we've bounced off of it once again, as we did, both times previously, but I don't like 3 tests of resistance. I like,
Right.
I'm sorry, support. I don't like 3 tests of support because there's a tendency. Usually you break that support thereafter. It's the same thing when you test the ceiling 3 times. Usually you break to the upside. When I say usually, I mean it just like that. It's more than 50%.
Seth, I have decided that I'm in the TECL to stay long term.
Now, can you educate the audience on what TECL is, please?
If I got the right ticker, the 3 times technology, is that?
Yeah.
Okay. I want to make sure I had the right symbol. It's just a 3 times bull ETF. I've seen some other people in our room buying bits of it and selling bits of it over the past year, and I did just a tiny bit of it, and then I stayed away from it. And now I think it's a good one to, not with a huge position,
right,
to get in, to possibly build a little bigger position over the year, depending on how things shake out, because it is beat way down.
Yeah, I mean, the technology sector, and that's the thing here. This could very well be one of those less probabilistic times that the support does hold for a 3rd time, and it acts as a slingshot. Look, if this market is going to work, if the S&P 500 is going to work, the NASDAQ is going to work, technology has to bottom if it hasn't already. Sure. Because it's, for the S&P 500, it's, I think, 26% of it's the heaviest weighted sector in the S&P 500. So tech has to bottom if it hasn't already. And you look at Apple, you look at Microsoft, they both got beat to crap into the year end and in the first week of this new year. Mm-hmm. So it serves, to figure that kind of price action would take place ahead of earnings season. So don't be surprised if earnings aren't that great from Apple and Microsoft, yet stocks may still perform well because a lot of the bad news or potentially bad results have been priced in ahead of time, market being the forward discounting mechanism that it is. But to be aware, we need to be aware, for all the good that is taking place in the market, for all the good that's taking place in the market, we're mindful that, it's not a perfect picture right now. This is January. This is the January trifecta indicator as we keep track of what's been taking place since the end of December into the new year. The Santa Claus rally, SC rally, happened. It wasn't a big rally, but it was a 0.8% gain. It's the last 5 days of the trading year and the first 2 trading days of the new year. That's the Santa Claus rally period. And the first 5 days, FFD is the first 5 days of January. That was also positive, actually a bigger return at 1.4%. So the only thing left in the January indicator trifecta is the January barometer. JB is January barometer, and that's the monthly return. If it's positive, when we've already had a positive Santa Claus rally in first 5 days, you make the trifecta. And the trifecta years are, if you have the trifecta, it's happened 31 times before. Only 3 times was the market down that year. Only 3 times with the market down for the full year. When you've done the trifecta, the data goes all the way back to 1950. This is from Yale Hirsch of the Traders Almanac. So all we need to do is finish this month with a positive return, and it is a power. That's 90%, folks. 90% positive.
When is the last day for the toy?
The 19th. So we have until January 19th. That started November 21st of last year. The toy barometer period goes from November 21st, because the 19th was on a weekend, so you have to start the Monday, and Monday was November
Right.
21st, and it runs through January 19th, which is a Thursday next week. So for a bullish signal, we have to have a greater than 3% return. So we started at 39.65. Okay, that's our starting point for the toy barometer last year. We have to get to 40.90. 40.90 to get a greater than 3% return. It's not out of the question. It's basically 107 points or so is what we got to get to, if it's going to be a bullish signal. Now, if we're just above, if we have just a positive return, anything above 39.65 would be a neutral toy barometer signal. And the forward 12-month returns are 50-50, basically. It's not it's neutral. What we want to avoid, obviously, is being below 39.65, because that would be a bearish signal. And the forward 12-month returns do skew to the downside for the market over the next 12 months. So it'll be interesting, because what if we do, have a positive January, but actually finish just below 39.65 on the toy barometer? I'm not sure that's ever happened. So we'll see. That's why we pay attention to this data. It gives you a really good idea that all of this data around the turn of the year, it gives you a good idea of whether the character is changing in the market. That's why this data is so relevant. So should I get in? Should I allocate? Are the signals there? These are some of the most important signals. Another important signal came from Jamie Dimon back in June of this year, saying, beware of an economic hurricane. I'm being highly sarcastic. Folks, when he said that in the first place, I'm like, give me a break. Come on. An economic hurricane? What does that even mean? And he, went on Bloomberg and, gave all these different interviews about it. And it basically just means he thought things were going to get bad. But just yesterday, JP Morgan Chase CEO Jamie Dimon sticks to hiring plans, and he dials back his prediction of an economic.
Yeah.
That's why I say, like, when these people make headlines and they say these things, they can't predict the future. It doesn't matter who they are. It doesn't matter if it's Jamie Dimon, if it's the president of the United States, if it's Larry Summers, if it's Jerome Powell. They can't predict. They don't have a crystal ball. It doesn't matter how many hundreds of thousands of followers somebody has on Twitter. Nobody can predict what's going to happen tomorrow, next week, next month, the next quarter. We know what happens over time, but short duration outlooks are just foolhardy. And folks, if somebody could predict that, they wouldn't be telling you, because they wouldn't have the time. They'd be on a beach with margarita, and enjoying themselves because they've won the lottery 50 times over,
Right.
So
when Diamond made that statement, I was a bit taken aback, because it's not really like him to get that.
I agree.
And I thought, this guy either had a bad day or he's had 3 or 4 days of looking at some bad news or something. Something's going on.
Bad birdie.
It was emotional. It was, yeah.
I thought it was just pure nonsense at the time. And lo and behold, here he is walking it back. So just be careful, folks. I often say, tune out the finance, turn off CNBC. Just turn it off. The practical utility of CNBC and the financial media is very muted. It's very muted. So why not just hit the mute button in the first place? And here's another, what's his name? Jeffrey Gundlach's been in the financial media a lot lately, basically critiquing the Fed, like Jeremy Siegel. He's been in the financial media a lot. Everybody just hitting the Fed over the hammer, believing that they're over tightening and they're going to, run us into a recession. Jeffrey Gundlach, he had tweeted out the other day. He said, if you look at the only treasury that is at or above the Fed fund rate right now is a 6-month treasury. And he said emphatically, the Fed is not going to get to 5%. The Fed is not going to get to 5%. Now, this is the same guy who in May of 2020, Jeffrey Gundlach, he runs the biggest bond fund in almost the world, Double Line Capital. In May of 2020, he came on CNBC and he said, I shorted the S&P 500 at 28.46. And literally the S&P 500 did nothing but go higher. It never looked back. My point being here is, who cares what he says? Sometimes he'll be right, sometimes he'll be wrong, but he can't predict the future. His luck is as good as a coin flip. And in the same, report, he puts out this chart right here from Double Line Capital, Jeffrey Gundlach, the Fed balance sheet in the S&P 500. And so this is the S&P 500 in the yellow going higher. And the shaded area is the Fed's balance sheet. And, basically it puts on this, it gives the impression that as the Fed runs off its balance sheet, as it did since June of last year, the S&P 500 falls, right? And I put these arrows on the chart. These are mine, all right? And this is why I say these charts are very misleading. They're very misleading because they're not indexed to the same value. This is the S&P 500 price, and this is this axis over here is the Fed's balance sheet. Are they indexed to the same level? No, they're giving you two different price values. The only thing that is constant and equally shared amongst these two different values is time. That's it. You can't get a correlation coefficient, meaning this is causing this, or this is very highly correlated with this, unless they're indexed to the same value. And the best way to do that is simply index the two values to 100 and then see how they track. But even though we're not doing that here right now, we can see there's really no relationship. The Fed was doing quantitative tightening since 2017. You can see the balance sheet run down here. But look what happens to the S&P 500. It goes higher over time. Did we have corrections? Yes, we had corrections. That's a normal part of every year. But we still went higher. So there's no relationship. But people will look at this and they change the scale of the layover chart here so that it looks like there's a perfect correlation between the Fed's balance sheet and how the S&P 500 performs. And the third thing I'd like to emphasize here is, what are we really comparing so far as sample size? No correlation. And here's a second example. We just have two samples, One says no, just looking at the chart. The other makes it look like it's yes, that it's correlated. So these are my pet peeves, but people will believe it. I mean, you hear Josh Brown on CNBC all the time, but the Fed's not going to stop running off their balance sheet. Quantitative tightening, it's going to destroy the market. You can't. You have to expect lower lows in the market because they're still going, even if they pause rate hikes, they're still going to be running off the balance sheet. What do you say?
Yeah. This whole time you were talking about, I was thinking about, to me, maybe I don't watch enough of that noise on the TV. Sometimes when you run those videos, I turn the volume down. But nobody's talking about the real economy.
Yeah.
Don't forget, there's tons of infrastructure money going out there right now. And, in my little community here, we're seeing lots of it because we've got the trifecta of energy going on in my county, in this little bitty county, and you can't rent a home here right now because the Fed is helping to put in all this stuff,
right?
With that infrastructure money. Texas, for example, even though it's an extremely conservative state, Abbott announced that we're going to put charging stations 50 miles apart on
I
all
heard
the
about that.
interstates
Yeah.
with Fed money. You know?
Right. Right.
So there's
Yep.
and there's reason to believe that. I think this inflation, you were saying this way back, and I agree with it. I don't think the Fed has had much to do with the whole inflation picture anyway.
Oh, I don't need.
I
Yeah,
think
this is not. It wasn't their fault, and they're.
we got hit by a war. We got hit by the COVID crisis. Supply chain disruptions like we've never seen.
Right.
And I always
China
felt like that
lockdowns, yeah.
when that fixed itself, everything would be fine. And of course, as a result, we got a wage reset.
Mhm.
But it's reset.
Overdue.
It's not going to keep going up like that. You know,
Right. The
so
last wage data was actually much more tempered. The last one, they were looking for, 0.5. It came in at 0.3 hourly
Yeah.
wage growth. So all of these things, when it comes to inflation, fix themselves over time. I look at, how much of an impact, like what we've come from 9.2% CPI in June down to what did we read today? 6.5%. How
Yeah.
much of that was because of rate hikes? I mean, housing is the only thing that's been disrupted during this whole. Have we lost jobs? Nope. We have more jobs today than when they started hiking rates. Did retail sales go down? No, retail sales have hit record high levels. Like, none of this is because of the Fed. It wasn't the Fed's fault when we got hit over the head with a sledgehammer when Russia invaded Ukraine. And it's not to the Fed's credit that, in my opinion, that we've seen 9.2% CPI come down to 6.5%. Because the economy seems quite robust, today still. We still have gainful employment. Consumers still
Seth,
spending.
I've lived quite a bit longer than you, and I've never seen so much craziness in Congress. And they're so
said, this was funny
into their own sides, and it's like the Hatfields and McCoys almost. But the good news is, behind closed doors, they're trying to solve problems, both sides. How can we ease up on immigration a little bit, because we need workers,
right?
And they're trying to figure that out.
Both sides are, without
they can't
losing
help
their base.
But play the politics on the border,
right?
Both
They
sides
can't lose their base, but they know they need workers,
right? So both sides have got to play that game, but quietly they understand we have a very robust economy that needs workers.
Yeah, there's somebody had said about McCarthy. They said, what do you call somebody who has to, who only gets voted House Speaker on the 15th time? Mr. Speaker. I mean, he's still going to be called Mr. Speaker no matter how many times it takes to get voted. I thought that was pretty good. He's still the House Speaker.
But I have a feeling I'm going to be tuning out the political news a lot in this coming year.
It just seems to get worse and worse.
Yeah.
All right, we talked about the yield curve, and this is a chart that we've shown a few times in the past, the 10-year minus 3-month inversion, and how many months it has historically taken from the inversion to the actual recession. It can be, as the average lead time is 24 months. And as I've said before, if something takes that long on average, or even the maximum was 50 months, it's not the inversion that's causing anything. It's just a coincidental factor, or it's a symptom. It's symptomatic of an issue within the economy, but that doesn't cause the recession 24 months later on average. Now, here's another chart that is another refresher from the Lighthole Group. S&P 500 total return. The first 2 years after the start of Fed tightening cycles. The first month, the 10-year T-bond yield is less than the 3-month T-bond yield inverted during sustained inversion cycles. And as we can see, almost all the time, 2 years later, which is the yellow candle here, the yellow candles, almost positive 2 years, except for, of course, the dot-com period. Dot-com period was the outlier, and 2008. And I often try to remind folks, because that was a back-to-back down year in the market. 2000, 2001, and 2002. We didn't finish with the bear market until March of 2003. But, you know, those anomalies, people don't realize the economy and the market was recovering in 2001. It was in recovery mode, and then September 11th came. Like, you know, if that's what you think, there's this kind of another anomalistic cycle that we're going into, where we're going to have back-to-back down years, then we need something not like 9/11, right? Because we get these calluses, you know, in our minds. We get these calluses. We're hardened to those kinds of, you know, event risk, the terrorist event. It has to be something magnitudes worse than that. And I would argue, since we've had a pandemic that shut down the entire global economy, it's got to be worse than that, you know, to produce that kind of economic cycle that we saw from the dot-com boom through 9/11. Point being, don't be afraid of the yield curve inversion, folks, you know, because over a 2-year period, the returns are very, very strong. And quite, I didn't even know this, because, and most people don't, because all we hear again on the financial media is the 3-month and the 10-year, the 3-month and the 10-year. But the most predictive or correlated part of the yield curve when it comes to 4-quarter forward GDP growth is the 5-year minus the 3-month. That one has the highest correlation coefficient. And behind that is the 7-year and 3-month. Behind that is the 10-year and 3-month. But, you know, everybody says, you know, the 3-month and the 10-year, so it just gets repeated and repeated and repeated. But the most correlated with 4-quarter GDP growth is the 5-year and the 3-month. And here again, we talked at the, you know, we kicked off things with the Campbell Harvey and his commentary on the yield curve. This is his exact quote: "My yield curve indicator has gone code red, and it's 8 for 8 in forecasting recession since 1968 with no false alarms." And he's a professor at the University of Duke. But here he also says, "I have reason to believe, however, that it is flashing a false signal this time." So there it is for yourself. There's the link to the Bloomberg article, folks. Is this time different? We don't know today. We'll know probably by the end of the year. Campbell Harvey himself believes that this time is different when it comes to the signal from the yield curve. Now, are things perfect in the economy? Nope. You know when they've been perfect in the economy? Ever. The economy is never perfect. There's always going to be something to. Well, we wouldn't have a financial media if the economy was perfect. So there's always going to be something to nitpick. There's always going to be some aspect or some industry that is suffering or underperforming. And through the back half of 2022 was manufacturing, the Purchasing Manufacturing Index. And this is for services, because we're service oriented economy, and services went below 50 as of the latest November reading. 49.6. Technically, the 50 line is the separation between expanding services or contracting services below 50. So we've dipped into a contraction within the services Purchasing Manufacturing Index. The new orders component within the ISM also, just plunged, just fell off. What I also would like people to recognize is this is the prices paid index within the ISM. And this has been falling off for many months. And while everybody, oh, we have a manufacturing recession. Now look at the services PMIs, purchasing manufacturing index. Look at the new orders have, basically broken into a zone where you typically do have recession. The shaded lines are recession. This is the new orders component of the ISM. And I mean, that doesn't look good. Admittedly, it doesn't look good. But like I said before, look at the prices paid. Now, when we do a little bit, deeper dive, here's what we find. This is the NOPE index. Again, this is developed by the newly retired Jim Paulson. Sorry, Jim Paulson of the Lighthope Group, 40-year industry expert, strategist, and analyst. And he created the NOPE index. And essentially what he did was he took out the prices. He took out the prices paid component of the ISM, and this is what he finds. Basically, new orders are climbing, and they've been climbing for many months, and they're now back above zero. NOPE stands for new orders minus price. It's new orders minus the price. And if you take out the price, activity is still strong, but the prices are weighing. Think of it as a corporate balance sheet, right? I mean, if prices are going down, what's going to happen to your revenues? Your revenues are going to go down. Does that mean that your transactions are going down? Does that mean your activity is going down? No, but the prices per unit that you're selling are going down. That's going to have a negative impact on your sales. It doesn't mean you're selling fewer goods. It just means the goods that you're selling are at a cheaper price now. And that's what's been happening in the ISM for both manufacturing and services. And this is what everybody's overlooking. I constantly rhetorically say, come on, folks. The leading economic index has been down for 9 straight months, which ties the record. The last time we were down for 9 straight months, we were in a recession already. Almost every time that we've been down in the LEIs for 6 months or more, it's led to a recession. But usually you also have job growth for the non-farm payroll report has been 50,000. So we're still at 250,000. And we don't have a recession. Manufacturing is 45. Services are now 49. The LEIs are down 9 months in a row and we don't have a recession. I think people are not recognizing how much disinflation is taking out of these metrics. The egregious impact they're having. I mean, if we're not manufacturing, if we're in a manufacturing recession, if we're in a housing recession, if we're now in a services recession, how come people are still hiring? It's this prices component within all of these indicators. I mean, every indicator in the LEI, except for the S&P 500, has a price component. If we've just gone from 9.2% in the CPI down to 6.5%, don't you think that's why the leading economic index has been down for 9 months in a row? And yet we're still not in a recession. This time, I mean, there's so much nuance that we have to keep an open mind. I guess you have to realize we created 4.5 million jobs last year. Does that sound like a recession, folks? I mean, God, come on, 4.5 million jobs.
Seth, aren't we on track for a little over 3% GDP for the fourth quarter?
Yeah, it's tracking. I think it was 3.8 or 4. Sorry, 4%.
Yeah, that's very recessionary.
The Fed. 4.1%.
Very recessionary, huh?
Yeah, to your point, exactly. 4.1%, which was a revision to the upside. The previous tracking was at 3.8%. So it just updated this week to 4.1%. Yeah, I mean,
I've also been tracking the spot price of lumber.
Uh-huh. Has
It's
it
down
bottomed?
to, oh, it's down to where it started.
Uh-huh.
But I don't know how long it takes for that supply chain to fill through, because lumber is still high at the store, but it's not going to stay there.
Yeah, yeah. Futures prices have come way down, but the retailers, you know, some of the prices have been sticky. They've been able to pass through to the customer. And if you're Home Depot, if you're Lowe's, if you're Ace Hardware and you can pass it through to the customer, until the customer says no, then you keep the prices. Again, I've always said, why does the Fed have to do anything? When the consumer
Right.
says no,
Right.
then things will change. Let the consumer speak. Why do you have to hike rates to the point that maybe we do find a recession and people start losing jobs? It's a consumption-based economy. Let the consumer do what it's going to do. I said earlier that, once shelter inflation hits the CPI, it's going to hit like a ton of bricks. This chart from, I forget the gentleman's name, Jason Foreman. This is core CPI inflation with, if we were to include new rent prices, inflation would be negative. The CPI would be negative. That's why I say the Fed can easily go too far because the data's lagged. It's using data that is lagged many, many, many months. Used car prices were down year over year, almost 15%. Like, we're in a disinflation. Forget an inflationary spiral. We're in a disinflationary spiral right now. I think things will start to, I guess trough, you can say, and we'll get these kind of ripples. But that's always how it's been, right? It's not like we dip down to 1% CPI. No, we usually are around 1.5 to 2% CPI in the post-Great Financial Crisis era. So even if we do that, the year-over-year number is still going to drop. It's just the month over month is going to, just basically bounce around. When are the greatest returns for the S&P 500? It's color-coded. During major disinflation, the S&P 500 annualized returns are 12%. During the rest of the time, so any other period that isn't a disinflationary period, the average return is 4.2%. This is technically, the better time for markets to perform as we are in this disinflationary period. I was saying before, non-farm payrolls, usually before you go into a recession, you're only gaining maybe 50,000, and here's your recession. Maybe 50,000, and then here's your recession. 50,000, here's your recession. We're still doing like 250,000 in monthly payroll gains here. And this is the other thing you hear a lot about, right? The only way that the consumer has been able to suffer this inflationary year of 2022 is because they've had to take on multiple jobs. I can't, it's just all over the place that people say that. It has absolutely no truth. Only 5% of the job categories are multiple job holders. Only 5%. So some of the things that we hear out there are just nonsense, quite frankly. There's just not a lot of truth. So, here we are, 2022. Market is starting to show some character change. Ideally, we've got a couple of signals that we still want to see completed. The January barometer with a positive return, and the toy barometer with at least a neutral signal, and at best, a bullish signal, achieving 4090 by January 19th, which I believe is next Thursday, a week from now. So any final words, Mr. Carter?
I was wondering if you've changed your thoughts at all about, I think maybe a month ago, you were thinking that this year we might see a bottom that was even lower than the previous year's bottom, and then things would get better again. You still?
So the market is the guide. The price is
Yeah.
truth. And, if this market fires both of those signals that we both talked about, there's a 90% probability that just won't happen.
Yeah.
I think the strategists, the analysts have overemphasized and over scrutinized the potential year over year earnings weakness that they think we're going to see. But as we've entered the new year, the economy seems on stable footing. And I think a lot of the mega cap names have already, reduced some of the weight on their balance sheet by way of, laying off folks and shoring up the balance sheet to perform better and to drive better earnings for the new year. You think about Microsoft, you think about Goldman Sachs, these companies have announced layoffs. You think about Amazon said it was going to lay off 15,000 workers. That has all basically signaled, hey, we're going to deliver earnings. We're focused on the bottom line. That's why we're shedding this dead weight, basically. So the market is digesting that information as positive, and why I think we've actually started the year better than we did end the year and begin the year last year.
Yeah.
Market is listening to these companies that are saying, we're going to do this because we want to deliver better than expected earnings. So I think it's
and if you look at the numbers that some of them have laid off, that pales into comparison to the hiring they were doing.
Exactly.
Exactly. They're just trimming. They're not, they make it sound like it's a big headline, and it's just not.
Right. Yeah. And we look, the mega cap companies are but a couple handfuls. Small businesses are the backbone of the labor market. That's where the jobs are, the small businesses. So, as things are starting to crystallize here in the new year, and we'll get more of that starting tomorrow, because we get JP Morgan, Bank of America, Wells Fargo, and Citigroup all reporting. So, we'll get to hear from some of these companies what their outlook is for 2023. So a lot of the haze over the early parts of this year will start to fade away, and we'll have a clearer picture of what we might anticipate in the first quarter as a whole. And, as January goes, the year is likely to follow.
It seems like the banks ought to have a stellar year this year. And the reason I say that, with all these interest rate increases, they're not paying us as depositors more.
They're not. They're not.
So there's some money being made there.
Yeah, I mean, as a sector, the financial sector is supposed to deliver in the fourth quarter year over year declines, but that's already expected. I mean, we've seen JP Morgan go from $101 a share to this morning $140 a share. And that's all happened in basically the last 90 days.
Yeah.
Since it last reported. $101 to $140 this morning it printed. So it's really difficult to see, unless we do go into a recession, and we really start to see bad employment numbers and bad retail sales numbers, it's going to be hard to get back down to that 3,500 number.
Yeah, I think so too.
I'm not saying it's impossible, but the odds are looking less and less probable, in my opinion.
Yeah, and if it starts looking recessionary, the Fed knows how to navigate that better than ever now.
And it'll have more tools. It'll have more leverage, because it'll have a near 5% Fed fund rate that it can drop 100 basis points, to shock the system back into expansion. So it's a double-edged sword what we've gone through from 2022, whereby they hiked at the most accelerated pace since the 1980s. But it's also given them a war chest to combat any recession down the road. So.
Yeah, I think the most likely scenario is the best of both worlds. Hiring is still going to remain relatively high, 200,000-ish, and inflation has peaked and is going to continue to fall. And so you're going to have those two dynamics going on, and that's just going to push the market higher.
So I tweeted out earlier, kind of an updated, because I've said, while I don't want to understate or overstate, but I've said that a recession was improbable, but it became increasingly probable, in the fourth quarter period, based on what we were hearing from the Fed and just the overall S&P 500 price action can become a self-fulfilling prophecy in the economy. But this was still my outlook. It's unpopular, but I could support it with data. There's actually only, and most probabilistically, a 15% chance of a recession in the coming 12-month period. So that's what I think the probability is, 15%. However, and this is why we've been talking about a character change. I've got 10 bear to bull market signals that I've used over the last 10 years or so, and 8 of them have turned from bearish to bullish. Only 2 are left to turn, and 100% of the time that's happened, it's been the correction bottom or the bear market bottom. So we shall see. All right, with that, thank you again, Brad, for joining me, co-hosting. Thank you, everybody, for tuning in to this week's episode of State of the Market, and we will see you next Thursday.